Welcome back to the Investing on a 9 to 5 podcast. It is me, Teddie, along with Paul. On today's episode, we will be talking about dividend growth investing, and then Paul will be segueing over and talking about options trading today. But just to keep it quick, we'll just be going over some light news today, over what happened in the stock market, and I'm gonna hand it over to Paul just to see what's happening in the market.
Man, it was you know what I've noticed today? It's been so weird how one company reports something bad and everything just tanks. We've had some good earnings from a few companies,
Yeah.
but one company reports bad, or one company has bad news, and everything just sells off. Like today, it looked like we were starting to have a decent day, and then boom, it took a dump in the bed right there.
It absolutely just teeters her off till about 11:30, and then by 3 o'clock
Right.
you're like, wait a minute, what happened to all my gains for the day? What
So,
company what did you see that was out there that caught your eye?
it was more today. I don't even know what started it earlier was because I think people are looking at good news for the election. They're hoping that either the Republicans win or there's a split government. Because in everything I've read, people are feeling that leans toward a more positive stock market, a more positive business environment all around. So I think
Right.
there was some people going in this morning thinking, okay, we're going to have a good day. It's the election day. It's maybe a little bit slower, a little bit less volume. I'm not even sure what really happened to make it all of a sudden take a turn in the middle of the day, but it went like, way up high, a couple hundred points on the Dow to a negative on the Dow. And then I think it finished pretty strong. But then after hours, Disney reported not horrible
Oh,
earnings, but
no,
it
no,
took
not
a
horrible.
dump. Yeah,
Oh, yeah. I haven't even taken a look at that, but once I saw I was out with the dogs. Once I saw their earnings report came out on my phone, I was thinking in my head like, oh yeah, they are on the chopping block. They're
it's
going to
it's
get
it's
slaughtered
crazy.
tomorrow. Mr.
And
Market
I'm
is not playing nice with anyone. It's just he's just taking names.
and it's not forgiving anybody. Well, what happened
No.
today? I remember now that we're talking about it. It was the that, and it wasn't even a stock market news. It was the FTX crypto news. The Binance is buying out some of FTX's foreign holdings,
Okay.
FTX.com. And that's when like Bitcoin was down 10% for the day. All these companies just all of a sudden crapped out.
Yep.
And
And the crypto market has just been taking they've been taking a hit on that side as well too.
do you
The
do you do
market.
crypto?
Not a lot. I have a little amount of Ethereum,
Mm-hmm.
nothing crazy, but like if it's coming, why not
Are
have
you
a little
staking
bit?
it? Are you taking, because with it's like the whole dividend mindset,
Oh, no,
staking?
no, no, no. I don't even have enough in there. I think I have like $400 in Ethereum to like I haven't gotten to that point where I can stake it, or I
Well, you
haven't
can
even
though.
I've done enough oh, I didn't even know that. See, I haven't even done
Yeah.
enough research to know how to even stake it or
I've
do
got a
anything
little bit
like
on
that.
Coinbase, and you can stake it on Coinbase, and it's
Okay.
like a 3.5%, almost 4% return.
See, I'm missing out on money. See,
Yeah,
guys.
yeah, that's what we're here though.
See,
And
already
yeah, I'm
missing
the
out.
same as you. I've got a little bit of Ethereum. I've got a little bit of Solana, just holding those in case they do something. Not a whole lot, and it's just since I bought it. I think I bought the Ethereum coin at like 1,800. Back in July or June, July when it was up there at 1,800. So I'm down on
Mm-hmm.
that, obviously. And the Solana I've just been buying since it's been around the $30 range. So I'm not too
Okay.
horrible on that one. But that's what
Yeah.
drove the market down today, I think, was that news that came out, and all of a sudden everything took a dump, which was
Yeah. And
crazy. I mean,
everyone
why does that matter to Apple?
and everyone gets scared, once
Mhm.
it's like everyone reads like their report card and gets scared, like the boogeyman's coming and like the
Right.
market just freaks out, you know. So
Well,
it takes a dive, and it's good that we get on and analyze and be able to talk about different events that go on in the market, just to let investors on a 9 to 5 just like you and I know,
right, right.
these things happen every day. So don't worry long term that the market continually will move in a positive trend. So
And that's what
that's
I see on the div twits, is they love red days.
yes,
Guys like you love the red days because you load up, right? I saw you all day
yes,
long. You're buying your SCHD and ET and stuff. So
yes,
tell me about what
Abby.
you're buying, man.
Yes. So my three that I've been loading up on is Energy Transfer, I've been loading up on SCHD. I will obviously go over these, and then I've been loading up on AbbVie. Those are my three, like my babies. So I've been loading up on those. They are been great in the portfolio. They're all three are actually beating the S&P 500, this year to date. So I've been holding them for over a year and a half now. And we'll be able to go in and see, what they're about and what they do for dividends. Because back to what you were saying about on the red days, the yields for dividend companies on when the stock goes low, the dividend yield goes higher because companies will want you to be more invested into the company because it looks like everyone's selling, right? Mm-hmm. So when we go in and analyze the companies, we'll be able to see basically, how I go in and pick out my favorite pickings and how I got to these three here. So I'm going to go ahead and share my screen with you guys. And we are going to be looking at my first one, and that one will be AbbVie. So AbbVie is ticker symbol ABBV. They are a huge pharmaceutical company. Do you know anything about them? Have you heard of them?
Is AbbVie the one that they're losing one of their main drugs up here pretty soon? Is that the one there's a lot of fear about?
Bingo, bango. Fear. You. Don't worry. That's why we're here. Yeah. So here we go here, right? So they are an elite pharmaceutical company. Dividend King AbbVie. It's what I like to call them. By being a dividend king for any new investors out there means that this company has been paying and increasing their dividends for the past 50 years. So it's like a rep sheet in the dividend streets. So every goal is to be a dividend king. And that's AbbVie's obviously goal here. So this is a live report sheet here of AbbVie and basically Stock Rover, which you can go on and get their premium service, and I pay for this. But we can obviously use it here and be able to use it at no cost. So I go in and look at what they do and who they are and how they make their money. That's one of the things I look for before I invest in a company. It's like, what do you do to bring in money? Because as a dividend investor, I need cash flow because that's what I'm looking for. I'm looking for cash flow, right? So they have to be bringing in lots of cash. So I would go down and see, like, okay, let's go down and look at the dividend yield. Awesome. Another metric that I like to look at, obviously after looking at their cash flow, we'll go back to it, is looking at their dividend report card. This is basically the heartbeat of what I look for basically first before the cash flow. So there is a system that I have been using for the past like couple months. I haven't really tweeted about it or anything, but I got it from this book out of Get Rich with Dividends, and it's called the 10, 11, 12 system. Okay. So this system, it has a certain, obviously you have to search for the stocks that has a certain amount of requirements to meet it. And I'm going to break it down for you guys. And AbbVie meets, actually all three of these stocks meet the requirements of the 10, 11, 12. So the 10, 11, 12 system is in 10 years, you will be yielding 11% with a 12% return. Oh, now, wow. In order to get that 10, 11 sequence, the stock has to have at least a 3.54% yield. The dividend growth rate has to be over 10%.
So this is where the difference between dividend paying, just being a straight dividend investor or being a growth investor, this brings in, investor. Okay, so this is your dividend growth.
Yes, this will be a part of the dividend growth strategy. Okay. So what that entails is I purchase companies that pay quarterly. So AbbVie pays every quarter, so every 4 months, and I get that dividend and I reinvest it back into the company. Now, in the meantime, every quarter, they are raising their dividend. So that dividend growth rate means that within that year, the company would have to raise their dividend within at least 10%, meaning that they are keeping up with inflation. So okay. You're beating inflation, one, by being a dividend growth investor. And then you're also, two, you're getting the capital gains from the company as well, because they are also a growing company that's continuing to grow.
Get it? I get it.
Mm-hmm. So those are like two of the criterias that I mainly look for in that 10, 11, 12 strategy. Obviously, the payout ratio is another thing that we look at dividend investors, meaning that can they cover their dividend? So my threshold, not any financial advice on any of this, is that I like to look at anything under 65%, above 30% is about my threshold. Now, as you guys can see here, Avi is at 73 or 76%, right? So you're like, all right, but they are a dividend king, means that they've been in the game for 50 years, so they know what they're doing. They obviously their team knows what they're doing, so I'm not going to let that alarm me. So that's, and as you can see, that's just two of the metrics there
What
that
is
like
that?
basically
What
break
does
it
that
down.
payout ratio represent? What is the 76% of?
Of their of their tax, not their taxes, but after they pay all of their bills
Mm-hmm.
and income, after income and
Okay.
pay all of their bills. So that's just what's left over goes out into as it's like into dividend investors.
Right. So if I see a company that's got a payout ratio like close to 100%, that means
Yes,
every free penny they have, they're trying to keep that dividend
they're
payout.
trying to keep the dividend. So anything like around like 100%, yeah. If there's a company like if this company wasn't Avi and it had a payout ratio of 76%, I would kind of be like questioning like, all right, they what's going on? Why is it so high? What is
Okay.
what is going, what is management doing? So you would do a little bit more, a little bit more in depth research
The strength of the
on
company.
on the strength of the company. Um, but since obviously we're investors on a 9 to 5, we have access to systems like Stock Rover, that I use, that they help analyze the stocks for us. So it helps break everything down as far as to what we should be looking for as a dividend growth investor.
Gotcha. Gotcha. Okay.
So you did mention that they are losing their Humira in 2025. They do have two other products
Mm.
that are doing very well: Renvoke and Skyriki. I think it's Skyrick. They're on commercials all
Mm-hmm.
day, on throughout the TV. So that's another way that I notice that companies are doing well too, is that I see the product and being, active, or I see people
Right.
purchasing the product. I see people, obviously people talk about a lot of Botox nowadays. So that's the huge product right there.
Gotcha.
So being able to see that as an investor, really goes a long way, for long term. And if you're worried about, if the stock is going to go out of business, or if the stock's going to crash or stuff like that. So that's just one way that I look at when it comes to dividend investing.
Okay. Good. I like it.
Yeah, and then they had a solid earnings report too. Increased revenue of 5%. They brought in like $14.1 billion last quarter. So it's just the cash flow is there. As long as they're bringing in the cash, the dividend investors are going to be continue to get the dividend raises, and the capital gains as well. So Avi, keep it on your watch list, guys. I think it's undervalued right now. It's looks like you got 9% undervalued. So it's a buy. So not financial advice, but definitely a strong one to keep looking, to keep on your watch list. My next stock will be SCHD. So this is the Schwab um, ETF that tracks the Dow Jones 100 index. So for those who are new out there, an ETF is an exchange traded fund, which means that they track a sector of the stock market and get all the best companies and put them all in one bag for you. And then you just give them $1 or a certain amount
Mhm.
for the money, and they give you everything that's in the bag, and you don't have to do any work for it. So here is why I like SCHD. We got some notes down here for it. It is out, like I mentioned before, it has outperformed the S&P 500 in my portfolio. Full disclosure, I got over 30 shares right now.
Working toward your 100.
Working towards my 100. Exactly. I will have 100 shares in that, and that should be everyone's goal, to have 100 shares in that. So cheers to that, Paul. It's got a growing yield, and it's safe. Now, before we get into that, I'm gonna break it down what is in these ETFs, or what is in this ETF and why I love this ETF. So back to the AVI, I use the same thing when I pick my ETFs. If the world were to go back to shutdown mode, will these companies that are on here be in need? So let's go through the list. Merck & Co., yes. Pfizer, duh. Pepsi, everyone's going to need their Pepsi, right?
Mm-hmm.
Texas Instruments, we can teeter that. IBM, chips, Home Depot, everybody's going to be bored at home, right?
Right.
Verizon, I'm going to need to talk to you, Paul. I'm again,
you can't get on Twitter without your phone.
Yeah, it's another pharmaceutical company, Coca-Cola, Cisco Systems, communication. So it's just companies that, if the world were to stop again, will these companies still be able to thrive? And SCHD has done a great job of putting all of these companies together into an ETF for dividend investors to get the full gains of it. This also fits into, I think it fits into the 10, 11, 12 system as well, guys. It's got a 4% yield. It's got a 15%, 15.1% dividend growth rate.
Wow.
Or 13.1% growth rate, 3.1 yield, 3.3 yield. I would still take that. Because I know it is a growing dividend. It's growing. I will take that. And then these companies that are in here, these are all risk-free companies. And in order to be included on here, guys, this is the three things that I like about it too, is that these companies don't have to have a minimum of 10 years dividend increases, of 10 years. So all of the companies that are in here have already done the 10 years to be considered in this. So like they have bragging rights to be in this ETF. Minimum cap of 500 million. So these companies have at least 500 million. And then they basically, like, trading volume daily has to be at least 2 million trading daily. So it gets lots of these
that's a good
companies.
Volume, then.
Yeah, got good volume on all of these companies. And these are favorite top dividend stocks that, hey, if you can't go and buy these all at one time, guys, because Coca-Cola was to $60. Verizon is what, probably
it's about
that as well.
Mm-hmm.
Yeah, I mean, Verizon is about that as well. Home Depot's $200 stock. So it's, there's just those add up. And the goal of our podcast here is to show you how to dollar cost average into these plays, to show you, saying, hey, like today, I only had $50. So I only threw $50 at this. Got me a half a share, but now I'm sitting over 30 shares just because I didn't buy a full share, I bought a partial share.
Mm-hmm.
So you can buy partial shares in the market. And then also ETFs, they also diversify you as well, guys. They help diversify your portfolio as well. So as you can see here, broken down here, it gets you in the financial services, industrials, you got technology, consumer defensives, healthcare, energy, and so on. So you have your own little mini portfolio by just paying one price. And that's go ahead.
No, I'm sorry. I was saying, so the SCHD is 100 companies, right? It's 100 stocks.
What's that again?
It's 100. It has 100 stocks in its holdings. It takes the 100 dividend payers.
Yes. Mm-hmm.
So my mind went to, like, the ETFs are great because, I mean, I don't have the time or even really the understanding of all these companies to do the kind of dive you're doing into these three. So an ETF, they do that work for you, like you're saying, that with the diversification and the due diligence in those companies to include them in the ETF for you.
Exactly. And they take all the hard work out of it, and the goal is to worry free and worry less of what your portfolio is doing on a day-to-day basis. The goal is to be and in with your family or whatever you want to do, and that your money's coming in, your money's safe. So this is just another vehicle to be able to use to to be able to provide sustainable income now and down the line as well. Because the only thing is, these companies are just going to continue to get better and better and better, and they know that they have to continue to perform to stay in this list, because they know investors love buying ETFs. They know dividend investors seek this, so they know they have to continue to perform. And as you can see, guys, the ETF, the 5 years, it has it's done 80% return. The S&P 500 has done 61%. This year, 1.6% return. It was beating the S&P 500, so I take that back. But 1.6. Look at the S&P 17, 3 years. I mean, it's beating the S&P, guys, and you can do it at $75 per share, and you'll be able to compete and be the same type of and get way better dividends than you would by purchasing an S&P 500 index, I think.
Gotcha.
Mm-hmm. And next up on my ticker here is my baby, my favorite, ET.
Very nice. I've heard lots about this one.
I have been, as you guys can see, it's up at 1227 that closed today. ET owns natural gas, NGL liquids, and be able to move it underground, and they're MLP, so they're the middleman. They transport all the liquids and all that good stuff to be able to make
the highway.
They help stuff to make plastics, and they actually own Sunoco. They own Sunoco gas stations. So even though Sunoco has its own stock, ET owns that. So being able to see Sunoco gas stations around, it's like, once again, the world would have shut down again. I'm pretty sure Sunoco gas station, we will need energy to keep ourselves warm and need gasoline and all that good stuff. So I'm going to break it down here and talk about Energy Transfer. So it is currently, as I mentioned, at 12.27. It's got a target price right now at 15.78. Once again, this is not financial advice. I think this may be able to double here by 2025. Once again, we are long term. I'm 20 years thinking down the line or down the timeline. So none of this is making money overnight or getting rich by next week or by next paycheck. So this is a great company to look at. Keep on your watch list. It's beating the S&P 500 this year, as you guys can see on the right here. 61% returns. The S&P is at negative 18. I mean, past year, 42%. And guys, this is a $12 stock. And I first got in this around $8. Full disclosure, I have over 300 shares. It currently has a dividend income. I think it pays us yearly like $3.40, and we just got a 15% dividend raise a couple of weeks ago, and we just got a raise with Abby last week as well. So guys, when they give dividend raises, that's another thing that also gets included into your income on helping you get to that income that you're looking for dividends. So once again, like Abby, they've been increasing their dividends for 50 years. What do you think they're going to do for the next 50 years? Same with SCHC. They've been increasing their dividends for the past 5-10 years. What do you think they're going to do the next 10 years? Now with ET, ET gets a lot of slack for the dividend community for a minute. I feel like I've like kind of changed that around just a little bit, because they've cut their dividend in COVID, right? Right. They cut the dividend. They cut it. And look at this. It's got destroyed because they had to cut it, right? But look at the dividend change this past year, right?
They're ramping back up to where they were.
They're ramping it back up. All because when they cut it, a lot of dividend investors, everybody ran away. Totally fine. But I went in and said, let me see why they cut it. there was a lot of debt on it. They had a lot of debt. If your company has a lot of debt, guys, they're more likely down the line will cut the dividend at some point. They're gonna have, like, something's gonna shake at some point, because you can't have a lot of debt and pay you guys or pay us at the same time. It just doesn't work that way. Eventually, some's gonna have to give. So management put into place that, hey, we moving forward, we are going to get the dividend back to pre-pandemic levels. And I said, bingo, bango, I'm in for the ride, guys. So I started loading up on the $8, $9 stock, and I haven't stopped. And yeah, they've been increasing the dividend like crazy. 73% dividend change this year. That's literally real.
Awesome. Mm-hmm. What's their rate? The 8.6? Okay.
8.6 yield. Look at the payout ratio. Wow. Look at the payout ratio. 56.5, right? That means they have a lot of cash to cover us now. Lots of cash to cover us now. And look at their industry. I always like to look at what their industry is doing. Industry at 207% out there, guys. They're giving you $1 a share for 12. So they're paying you out every quarter.
I'm going to put that one on my list, actually, now that you're telling me about it.
And this was at one point, this was at like 92 cents at one point, 90 cents. I remember when I first got it, I was like, oh, wow, this thing is only paying you 90 cents. Now I got 300 shares, or over 300 shares, and it's $1.
That's
and
good.
You really, and I haven't shown up to any transfer meetings.
I'm not the best at math, but I think that's about $1,200 a year you're banking right there.
Like I haven't shown up or anything for any of those meetings. And it just, and also the earnings per share, it's continually to grow, meaning like how much are they earning per share of dollar and how much you're paying for it. This is just another way of looking at a company and how they're growing with the cash flow. And because companies can, kind of like make an earnings report. Can they make earnings report look good, like companies?
So yeah,
they can, like, I think I read that somewhere. That's why.
Yeah, they can move things. It's all accounting, right? People who are much smarter than me, they look at and they move things to different quarters. They move things around as far as like taking, we got orders for, let's say you're an automotive company, and that you've got orders for 20 trucks. You can say, let's put half those orders on this quarter's reporting, and we'll put the other half when we actually deliver the trucks. Right. So things like that, funny things will happen. And so I don't know exactly the details of it, but I know things like funny business like that will come up, and these companies, I remember hearing a lot about it, like when GE was going through a lot of their trouble, they were saying that, like, take place. And we're going to bring on, we got some ideas for some guests to bring on that can talk more in detail about this kind of stuff too, so we can all get educated.
Exactly. Nope. And I'm excited to bring some big interviewers on and be able to go through any type of stocks that they bring on, any type of insight, because everyone has some type of insight in the market, and you always find a golden nugget in a conversation.
I've heard about this company, and I saw you post about it, that you added some to your portfolio, and I think a couple people commented on it that they were excited about it. They're you getting that the good job. And I never really looked into it. I've heard about it, but this little deep dive you put us on. So you've talked about 300 shares of this, your goal for 100 shares of SCHD. Are you developing your portfolio so you have set number of shares, or do you say, I want 2%, my portfolio is going to be in this company, 20% is going to be in this one? Do you have any goal like that? Or are you just accumulating right now, whatever you can accumulate?
So right now I've changed. I've switched gears. At the beginning of the year, I was grabbing everything. I was getting stuff. I was accumulating a lot of of every, like, I had Meta, like a Meta ETF. I was just grabbing all types of stuff at the beginning, and then sort of like the past 2 months, I've trimmed up the portfolio, and I've done like an extensive amount of research on everything. Like I'm talking about like 4 a.m. to like stand up looking at stuff.
Are you talking about night trading?
Yeah. Shout out to Dave. Also, go get his book as well, Night
Heck
Trading.
yeah, it's a good book.
And we'll have it in the description down below.
I'm a proud Hershey shareholder now, and my local bank. I own some shares of my local bank. So if y'all want to know
Yes,
about that,
buy
you
your
got to read the
banks,
book.
people. Buy your banks.
We'll get Dave
Um,
on. We'll get Dave on. I'm sure he'll come on and talk
yes,
to us.
yes, we definitely will. We'll get Dave on here. Um, but back with ET, right? Yeah, we were. I just started just doing a deep analysis on ET, SCHD, and AbbVie. I'm like, all right, world were shut down. These three in my portfolio,
Mm-hmm.
maybe Comcast, and maybe T AT&T. Those I feel like would be obviously Google and Amazon too, but I'm just thinking dividend payers.
Right, right.
These will be, I feel like these three here will be the most solid ones. So my goal for these three now is to get 100 shares in them. So I did that with ET at the beginning of the year. Now I got to go get AbbVie's a big one. 100 shares in that's a lot.
Right.
So, but I'm dollar cost and averaging. I'm not going out buying $400, $500 worth of shares every day. I'm doing $45, or when I do get paid, we like to pay ourselves first in the dividend community. So when we get paid, we say, hey, before we do anything else, we take a little bit of our portion and say, hey, we're going to put $50 here and 50 there. Now we go take care of our bills. That is what you call paying yourself first,
Right,
not
right.
going and if you want to go out and buy yourself a coffee, $5 coffee, go ahead. But going
Man,
out
that so drives me
and
nuts. Like,
spending stuff, and it's like, yeah, maybe you could have stayed at home for the weekend or something like that. But it's like, hey, let's go buy some ET and some Abby instead of and eat some pizza this weekend and chill out. Or whatever it is. But these are my three solid ones here that I want to get 100 shares in.
mm-hmm,
And then eventually, when I break those down, I will go for 100 shares in Google for growth, mainly growth.
mm-hmm.
Once I get 100 shares in these three, then I'm going to just tackle mainly
You get your core set up where you get that income from the dividends, and then you
yes,
can move on and start growing your portfolio other directions.
in other directions by going and buying the fun stocks. And I have a good list of
I mean,
just
they're not fun right now. I can tell you
oh
that.
no, but they look fun to me because they're cheap.
They are cheap. They are cheap.
But they are definitely taking a beating right now. It's like,
Yeah.
man, I just bought Neo. You go buy Neo or you go buy some Meta. Yeah, they go down even more. You're like, why did I
But
even
see,
do
that's
that?
and that's what I'm doing. I'm getting them at these levels now, and I'm setting my portfolio up with those companies right now at the prices they are and getting paid to do it.
Right. Mm-hmm. And guys, I wanted to show you guys this here. So I like to do charting. I like to go out and not to go out. I like to pull up. I use stock charts here for any investors out there that are looking to say, hey, well, how do you know where the risks are? Or how do you know if the stock's moving in the right direction? What does it look like when it's going down? Well, you can set up your charts. Like I said, I use stock charts. You can use people use
Trading
Fidelity,
View.
TradeView, or Robinhood now has advanced charting now that you can do a type of charting. I use this. It's very simple for me. There's a lot of technical indicators that goes into setting up your charts on what you prefer to do as a charter. You don't have to be a trader. You can just be a charter that just like to chart. You can just chart it up and watch the stocks move. And the charts tell the story. The charts tell the story on what the stock is actually doing. So as you guys can see, this is the yearly for ET. I think this is
21.
yeah. Yep. So as you guys can see, it's just been trending up. We have our ups, and then as you guys can see, we have our downs. We have we have some new lower lows, some ups again. See, we go from 1035 all the way down to 7. A lot of people will more than likely say, I'm losing my money, I'm getting out. Do not do that, guys. Do not do that. In a company like this that has a great report card that you guys can see that we've done the analysis on that's telling us that everything is moving forward, the market just likes to play games with you. Just likes to play games And then once you get all the way out down here, guess what it does? It starts to just chart itself back up. So, but long-term investors, we just ride the wave, because long-term, as you guys can see, if you draw a line straight through, everything will eventually go
Up
up.
and to the right.
Up to the right. But in the meantime, it's just going to go through different types of cycles. As long-term investors, the goal is to survive those cycles, and this is why we're here.
Mm-hmm.
And
I
that,
see that a lot, and I believe
mm-hmm.
it. The people who ride this market through until the end of the bear market are going to be rewarded. And there's a lot of people who aren't. I've seen a lot of people drop off of the fin twit. That were out there the last year or so with their diamond hands and rocket ships and stuff, and a lot of that stuff's gone. I've stopped following a lot of those people too, so
I
it
mean,
helps.
I'm not gonna tell you guys. I'm not gonna lie. I got in a little AMC GameStop action out there,
Oh,
but
yeah.
I didn't tread too crazy. But I mean, I jumped in the water and tried to get my feet wet.
Yeah.
But the thing is, guys, every time I jumped in those type of situations or those plays or those short runs, I always get the short end of the stick. For
Right.
some reason, the stock always decide it is done for the day, for the week. It is gonna go opposite of where I want it to go. So don't worry about when you see it running across the headlines, it's doing this or doing that. You gotta go get the facts.
Yeah. I
Because
definitely went through my FOMO phase, but I'm glad I went. I'm glad I'm through it.
everyone has. Yeah, everyone goes through it, and it's fun. I mean, yeah, it's fun when, especially when. No, don't get me wrong. I've had a run up once before with the stock, but don't get me wrong. It feels good when you see
Mm-hmm.
it just continue to just go straight up. So, but that, yeah, guys, this is how I look at charts, and I go in, look at Abby here. Abby touched 171 here. Um, at the top here, guys, and it's, as you guys can see, it's peaked above its Bollinger Band, meaning it's within its trending. As you guys can see how it's trending here. Now it's starting to break. It broke down all the way down to 140. What's that? 148 here. Market's
Mm-hmm.
kind of, it's consolidating here, right, Paul? That's what it looks like it's
Yeah.
doing to me. Now, if me as a long-term investor, I like this. Even though the market's down, it went back up. Now it's consolidating because the market has no idea what it wants to do, right? Everyone's freaking out.
I've seen a lot of comments about a rotation coming. They're rotating into energy. They're rotating into these safer risk off plays like healthcare.
And
So
pharmaceuticals.
that's and more than a few people who I have a lot of faith in their ability to look at the market and make some analytic decisions and comments. That's what I've seen quite a few times.
Yeah, and that's that, and that goes back to back to being on dividend, on the div twit, being able to engage with other investors that have Abby as well to get more insight on. And another thing that I like about Abby too, Paul, is now the Humira. Now, when that drops off, if I like to think of them as like an ETF within themselves. They have a
Okay.
bunch of products, right? So if something goes bad, you got something else to replace it. So it still can continue to soar. So if you've noticed on all of their commercials, if you've looked at Abby commercials, a lot of those Renvoke and Skyriki, or however you say it, that's what you are seeing now. You don't see the Humira anymore. So that's letting me know as an investor, aha, they know what's coming. They're
Yeah,
pushing
they're
these
putting their
two
money where it
hard.
needs to go.
They're doing the legwork now. So in 5 years from now, we still can get that 5-year growth rate dividend, get that 10, 11, 12 system going in, because we're going to need that in 10
Nice.
years. Mm-hmm. Yeah, and those are my three right there that I think everyone should have on their watch list, and I think those are risk-free stocks. They're beating the S&P 500, and those are been like they've been solid performers in my portfolio.
Yeah. I'm definitely up on the healthcare and the pharmaceuticals. I did on my last a Substack not too long ago. I did a little breakdown on Humana, which I think is
Uh-huh.
going to be, and it's gone up. It's done really well the last few days since that one. I've seen that come up on a lot of different lists too.
Yeah.
Well,
Heck
that's
yeah.
awesome.
No.
Thank you, man. ET, that's on my list. I'm gonna take a look at that tomorrow.
For sure. I'm trying to see if I had anything else about Abby. let's see. Nope. Oh, they're projected this another tip here. AbbVie has a projected dividend yield of 16.8% by 2032.
Wow. Holy moly.
10, 11, 12.
30. That's going to be awesome. Good. Keep
Yes.
collecting it,
Mm-hmm.
and you're buying it now, so that's going to be
Yes.
your dividend on yield.
What's that? I'm sorry.
I said that's going to. So that's when you look at if you buy it for $100 today, and you're getting 8% dividend on it. When the dividend doubles, you're still at your $100 cost basis.
Oh, yes.
So your dividend on yield is more, even though
yes,
it's not.
You're getting paid more.
The percentage worth of what you paid for it. Yeah.
Mm-hmm.
That's your dividend growth. That's awesome.
And that's when we're really going to need that income down the line, when this stuff is really going to start compounding.
That's what I've always liked. And I understand the mentality of people who buy like lots of Amazon, lots of Facebook, lots of Google. When they retire, they're like, okay, I'll sell some when I need, I'll sell some to fund my retirement, whatever it is. But to me, that never really made sense, because with you, it's the whole mentality of you're putting principal in the bank and you're living off the interest. You're never touching the principal. If you just collect your dividend, you never have to sell a share to still continue to get that money every month from the dividends, as opposed to having to start selling off your principal, which is two ways of looking at it. There's not a right way, not a wrong way, but I understand, to me, it just makes more sense to not have to sell the principal and to continue to collect money.
Exactly. Yep. That's literally the goal. And it's easy to do that as well. Very easy. Find a dividend company that fits the 10, 11, 12 system, guys. That 2 to 5 or 3 to 5% yield, dividend growth rate. That's over 10%. That's been increasing the dividend for at least 10 years as well. Those things
track record
in a low payout ratio as well. Those, the type of company like that can do special things for your portfolio, in your sleep.
There you go. Making money while you're sleeping.
Exactly.
Cool.
But yeah, we're gonna segue over to you, Paul. You are in the options field. That is over my head, guys. Paul does more of the trading side of doing more of the analysis of the charts, and being able to go in and buy and basically read the charts on a day-to-day basis. So Paul, I'm gonna let you take it away.
Yeah, I've done less of that. I did that for a while, and like we talked about before, going through the whole FOMO phase, I found that the day trading thing wasn't something that I had the temperament for. Watching those daily ticks on a 3-minute chart, 1-minute chart, trying to decide when to buy, when to sell. But so through my evolution as an investor, I found that the dividend community, I found you and other guys who are in that little group. And being older, I'm looking not super long term, not super short term. I'm not Warren Buffett old, but I'm getting up there in age. So I know I'm looking to juice my dividend, juice my income a little bit. So what I do is I'm selling option premium, which is a little more of a swing trade, I guess you can classify it as. So, and I'll bring up a little chart here and show you kind of what I'm talking about, if I can share my screen.
Okay. Now, swing trading, now that is buying on Monday and going to the next day, or do you do it week?
It's not necessarily day, there's no like rule as far as what the days are. It's just it's just not like a day trade is more, you're going to buy it in the morning and you may sell it before the end of the day, or you may sell it within an hour. You may hold it for 10 minutes. You may hold it for, the trading day, and then it's gone. Gotcha. A swing trade is more days, weeks, months. I'm not planning on holding it long-term for years, but I'm not going to turn around and sell it after it goes up a few ticks and collects profit on it. And that's mainly because of what I'm trading in. So this is here's my screen up. Can you see this chain for Apple?
Yep, I see. I think this one. Yep.
Yep. So Apple. So this is an option chain. And just real quick on options. So you have calls and you have puts. A call is it gives you the right, if you buy a call, it gives you the right to take the stock from somebody at a strike price. If you buy a put, then that gives you the right to give somebody your stock at a strike price. So if I am, let's say you're out there and you are looking to, you got 100 shares of Apple, let's say, and you bought your shares of Apple at $134. Okay. So you're looking at this and you're thinking, well, Apple's pretty safe at $134, but I don't want to lose money if it goes below $134. You may decide that it's worth it to you to sell a $130 call. I wouldn't sell for $9. That doesn't matter, but that gives you bottom line floor on how low your share is going to go. If you sell the call at 131, then that gives you the right to, I'm sorry, I'm going backwards. That gives you the right to buy it at that price. So you're guaranteed to get that share price no matter what the stock price goes. So your cost base is going to be more because you're paying money to buy it. And the same side, and the same goes on the put side as well. Now, what I'm doing is saying, okay, I like Apple at $138. If it goes to $138, I'm willing to buy it. But rather than shell out $138 per share right now, I'm going to sell this put for $180. So this person is going to sell me a put at $180, which means I'm going to collect $180 from them, and they're going to hold the put. If Apple goes below $138, then they're going to sell me those shares for $138. Now, my risk is it goes to $130. If Apple goes to $130, I'm still on the hook to buy it at $138. If Apple goes to $136, I'm still on the hook to buy it at $138. My benefit is I got paid $180 to do that. So that's basically $1.81 a share. So that means my cost basis has been reduced by almost $2. So it can go down to 136 and I can still put the shares at 136, and it's within my break-even window. If it goes below that, if it goes below that, then we're talking about I'm paying more than what I got for it.
And what you got for the stock.
Right. So that's where it comes into the choice of the strike. Now what I do is I look at Delta, which is right here, and Delta's got a couple different definitions if you get into options trading. Some people say Delta represents the amount that the option price is going to move for every dollar that the strike price moves.
That's what I've heard.
So so right here, so this says that for every time this Apple moves $1 in strike price, this option is going to move 14 cents. And that's kind of tough because throughout the day, this is going to fluctuate a lot, tick by tick, second by second. These numbers change based on the stock price.
Yes.
Well, another definition of Delta I've learned is it's a rough probability of how likely that strike price is going to end up in the money. So Thinkorswim shows you a probability of in the money, which is another correlation you can use. But not all. I don't usually use this one. I use Thinkorswim to demonstrate now because I think it's a very clear option chain to use to demonstrate on. I don't use Thinkorswim anymore as a platform. So what I like to do is I sell about a 20 delta. So to me, that means that strike has about a 20% chance of ending up in the money. So if I were to look at this, I would say, okay, I'm going to sell a put on Apple. I'm looking at the 134 or 135 strike. I might go in to look at some other factors as far as, how many, what kind of volume they're doing, what kind of open interest there is. But I would say I would go with the 134 strike. So that means I'm going to sell it at about $66. So my break-even price is going to be $133.40, right? So it can go down to 133 and I'm only about 40 cents in the hole. But I'm going to collect $60 in order to do that. And then I just wait and see. I sell weeklies. So every week I look at this chain and you can see that, there's a chain for each week of expiration.
Yes. So
So
you do the
that's,
weeklies.
I do the weeklies. So that's the selling of the put. Now what happens is, let's say it goes down to 133, 134, and I have that put. Well, on Friday, it's going to say, well, you're in the money. So like if this was Friday and I had a 140 put, this contract would be in the money. That means I'm getting 100 shares at a dollar, at 140 a share, $14,000. What I'm going to do then the next week is I'm going to turn around and I'm going to start selling calls on that.
Okay.
So I can, if I got this 140, let's say at $2, so my actual break even is 138. I'm going to start looking at 138s and up to sell if I want to get rid of it right away. If I want to hold Apple for a long time, I might go a little bit more out of the money and might use my 20 delta rule and sell this one. So if I sold this one right here, 144, I'm going to sell it for 80 cents. So that means I'm making another $80. So when I sold it the first time, I got $2 for it. My cost basis was 138. I'm going to sell another one now for 80. So my cost basis drops down to 137.20. So you see, each time you do a sale, your cost basis lowers a little bit. And I'll show you an example of that here in a second. So what that means is if the stock price goes up to 144, then now that person is going to take they're going to call the shares away from me. I'm selling those shares to that person for $144 a share.
That's what that means when people say calling their shares away.
So you get assigned puts and you get shares called away from you.
Gotcha. Okay.
So and I'm doing this on a lot of different companies. I'm doing it on Apple, Google, Tesla. IWM is the Russell 2000 index, QQQ, and
I hear QQQ is a good trade.
That's a good one. There's a lot of volatility.
Swings.
Yeah, you're looking at the volatility. You're looking at how much options action there is. So here's the volume. You can see like this contractor here has 500 shares traded. This one's had 26,000 shares.
So
this one,
I have a question about the volume. So for those out there that are maybe just now swing or learning how to swing trade, and you stumped up on this channel, you've made it this far. Shout out to you. With the volume being high, do you lean more towards that option on a higher volume, or for those that are just, or do you lean more on the open interest?
I'm going to lean more. Usually they're going to correlate. You can see they're going to correlate here. As the options become more popular, more eyes on it,
they get more even, is what you're saying? Because
there's going to be more correlation. Like there's a little bit off here. Like this one's got a 15,000 open interest and 29,000 volume. This open interest is how many contracts are active on that strike price. The volume are the number of contracts that traded that day. So it's like this is so you can look at the open interest and see how many people are actively in that strike price, and then you can look at the volume and see, you might have somebody, these people could be holding this one from months ago, and there's just a lot of people holding it, but there's more people trading this one. So that's just, it's something you got to, it's a thing that I don't really use those numbers as like decision making factors. I'll look at them to kind of guide me. If I was going to sell, I'd be looking at these numbers over here going, well, this one's got a little bit higher volume and it's got a decent open interest, as opposed to these two next to it and have lower interest but similar volumes. So I would go ahead and go with and you can see 5, 10s, those are going to be more noticeable. That just, people meant psychologically, they go for the round numbers, So what I'm going to do for this, for our listeners, and because I had a few people ask questions about this when I was doing this in Twitter, is what if you don't have a lot of money? I mean, I don't have a lot of money. I'm not rich at all by any means.
Neither am I. That's why we're here, guys. We're investing on a 9 to 5. We got to go to work tomorrow, right, Paul?
100%. So you can start this. Here's a couple examples with $1,000 in a brokerage account. With some options approvals. What I did was, I'm doing this with real money. This isn't just a spreadsheet. I'm doing this actually in my brokerage account to show y'all how to do it. So on November 1st, I bought $1,000 worth of Palantir. I'm using Fidelity, so you can go in and you can buy round numbers instead of shares like you're talking about. So we bought $1,000 worth of Palantir. I got 111.74 shares. So I turned around that same day, and because options are traded in 100 share lots, you have to have at least 100 shares. So I took 100 of those shares and committed them to a covered call. So this is what I was talking about. So I sold the call on Palantir. So I got 25 cents per share. So I netted 24.32 after commissions and fees. So now my cost basis was lowered because of that. What I did was to show how you can build up a portfolio. I took that 24.32 and I went ahead and I bought more shares with that. I got another 2 3/4 shares with that 24.32. So my original cost basis was $8.95. I spent $8.95 for 111.74 shares. After this sale and this sale right here,
right,
my cost basis is now $8.73.
Just like you mentioned, as you sell, your cost basis gets lowered,
exactly.
Right?
Every time it goes a little bit down. So this contract, Palantir took a dump this week after some battering, so now it's trading around $7, I think. So it's highly likely this is going to expire out of the money. It's going to be out here in the black. When something expires out of the money, you just keep that premium and you move on to the next contract. Yep. You got that money and you keep it and you just keep rolling. So theoretically, this is going to expire out of the money on Friday. On Monday, I will go and sell another contract on that. If I get another $25 for that contract, just to work it out, my cost basis is going to go down. Right. That should be a plus. So,
and this brings me back to ET. I've been looking at doing an option wheel strategy on ET.
Yeah, I was too. When you were bringing it up, I peeked at it, and here's the challenge you run into, and you'll see this with a lot of companies. So ET, this is this week's option. It doesn't have a lot of premium in it. You know what I mean? So you're gonna, if you, let's say you had 100 shares that you wanted to sell a covered call on, you'd have to sell it really close to the money to get $7 for.
Oh, it's not even.
You know what I mean? So this is the thing. When you look at ET, you're looking at, if it's in the money, then you're going to get 35 cents, but that's almost a guarantee that you're going to get those calls called from you for $12.
Right. Yeah.
You know what I mean? But then you look at a company.
I'm not trying to do that.
You look at Palantir, and we're talking about, this is this week's. Let's go one more week out. So I looked at ET. You're getting $20.
And Palantir is what, 720? So 100 shares, guys, that's only $720.
$720
just to get started into, small accounts options.
So that's one.
Start making, income.
That's one where you come out of pocket and you buy $1,000 worth. Now, the other way to do it, and I'm doing this real in my account,
shout out to SoFi.
SoFi. So with SoFi is you can go ahead and do what's called a cash secured put. Let's say you have $1,000, but you don't want to buy the stock. You do a cash secured put, which means you sell the put and you collect the premium, and you only buy the stock if your put is in the money. So this, I sold a $5 put on the 4th. It was not trading. It was trading above $5 when that expired on the 4th. So I just kept it $20 and moved on to the next. It's 20 because I sold two. Two at 5 is $1,000. I got $10 each. So that was after commissions and fees, $18.94. So then on Monday I sold another two for another $20. So this is a collection right here, cumulative premium I'm collecting on that shares. Now, let's say this one drops below $5. So I'm going to get 100 shares assigned to me, or I'm going to get 200 shares assigned to me, say for $1,000, because it's going to be $5 each.
Yep.
So that's minus $1,000. So now I got called at $5, but my cost basis is only $480 because of the contracts I sold ahead of time. And then I'm going to turn around and start selling calls on this instead of puts. So this is a way to do it without buying the stock outright. And just, you can keep rolling this. And this is what the wheel strategy is. You sell the contracts until you get assigned the stocks, and then you turn around and you sell the wheels, the calls on the wheel until they get called away from you, and then you flip back over to the put side. So I'm going to keep doing this every week with these two companies, and maybe on a monthly basis, we'll do a little update, and I'll update you guys on how it's going. But this is something for you guys without a lot of money. You can do this with $500 because it only needs one contract. So with as little as 500, you get these in these $5 stocks, and you're looking at some, you're looking at some volatility, like with Sundial or these other companies that, they're going to go a reverse split, make be $5 a share, and then within a month they're back down to 50 cents. So you got to be careful about that, because if that happened with SoFi, then I'm going to be in a world of hurt, right? I'm going to get put shares to me at $5, and if it's only worth 50 cents, then I'm definitely going to be in the hole. So you definitely don't want to do this with really, really speculative stocks. I feel good about SoFi. I think SoFi may be bottoming out. It's going to bounce around here, I think, for a little while before maybe it comes back. But this is a way to build a position in that without having to come out of pocket a whole bunch of money.
Definitely agree, guys. Definitely agree. And options, it gets a lot of oh, you better not try
Yeah.
that. You'll shoot your eye out, kid type of energy.
Here's the key right here.
Literally how I feel about options. You'll shoot your eye out, kid.
Yeah. Here's the key.
Nothing serious like that, but
no, it's true.
but
you can shoot you can shoot yourself in the foot.
Well,
with
yeah,
TD
yeah,
and
you can burn
Ameritrade,
you can, guys, if you try options, you will burn a hole in your pocket very quickly.
Yeah. Here's what I suggest, and this is what I did. There's some good people on Twitter that I learned from. Option Growth Trader is one. We'll throw his link in. I give him a shout out every time I can, because I really learned a lot from him. And the way he executed, the way he executes his trades is really, really, he picks some really good companies. They're not wildly speculative. They're pretty conservative trades, but they're right along with this mindset. TD has it. I know E-Trade has this ability to do a paper trade account. I'm not sure the other brokerages do.
I think Webull may have
Webull, I'm sure, has one. Yeah,
as well.
They're all free. I know E-Trade and TD is free. You just got to create an account and you have this paper trade ability. So they give you some money. You can see how the contracts move. It's not a scientific one, because the bid ask prices are a little bit off from the real chain. The fill prices are going to be a little bit more generous than you would normally get doing real live trading with other people, because this is computer algorithmic style. But you can see how, if you sold this contract and let it run to the end of the week, you can see how it affects your value, your account value, when you get assigned those shares. You can then turn over and start watching the shares and make yourself a little spreadsheet like I've got here to see how your account stacks up once you've been assigned those shares and how it tracks. So I definitely suggest that you paper trade, follow some reputable people. There's lots of people out there that'll charge you money to follow their trades. I've been down that rabbit hole, and I can tell you that for me, it wasn't profitable. I don't know about some people make money on that. For me, it hasn't been profitable. So
the only subscriptions that I have now are just the ones I've learned where it's like, hey, just do your own analysis. You can just go on Seeking Alpha or Yahoo Finance or things like that. But nothing against the Discords or anything like that. I just haven't seen a full benefit of.
I've found it's more worth my time and money to spend money on a Discord where they're exchanging ideas and analysis rather than buy and sell alerts. I don't participate.
I find some of these companies, when I'm researching something else,
right,
I would find like it would either get mentioned or it would be like stock relative. It would just be, and then you just go to say, that's when I jump in the rabbit hole there.
Right.
That's when you really, that's when you really get lost. And,
that's how I got into uranium. We'll talk about uranium in the next episode.
Been doing so well in my Roth, Paul.
Did you buy it? Yeah, good.
Yes.
good. All right. Yes. Well, it's getting late here. I should let you go. I know you're an hour ahead of me, but
well, I got all the time in the world. I'm just kidding. But yeah, thanks again for listening, guys.
Where can they find us? You're our social media manager.
Yes, I am the Dividend Dog. You guys can find me hanging out on Twitter, wagging my tail. Just kidding, at the Dividend Dog on Twitter. And you can find Paul at Legacy Finance.
Options underscore legacy.
Options underscore legacy. I'm going to do that again. Thanks again for listening, guys. I am Teddie, the Dividend Dog. And this is Paul. You can find Paul at options underscore legacy finance on Twitter. And you can also keep up with both of us here on our page at Investing on a 9 to 5 podcast, where we will be doing more analysis on your favorite stocks. Please drop us a comment in the comments about what you would like to see on the page next.
Yeah.
And we will see you guys on the next video.
Thanks, guys.